The silver market is approaching a moment that few participants are psychologically prepared for. Price movements that normally unfold over months are beginning to compress in 2 days and potentially in 2 weeks. What makes this period especially dangerous is not volatility itself, but complacency. Many observers are still anchored. Two familiar assumptions about how metals move, how long breakouts take, and how much warning the market provides before repricing. The premise of this investigation is that those assumptions may no longer apply. Silver is often treated as a secondary market, something that follows broader trends at a distance and with delay. That perception creates a false sense of safety. When attention is focused elsewhere, price moves tend to be dismissed as noise or temporary distortions, yet the current structure of the market suggests that silver is not behaving passively. It is reacting to deeper forces that are already active beneath the surface, forces that do not announce themselves loudly before acting. The time frame matters. This is not a long-term forecast designed to sound impressive while remaining unverifiable. The focus is narrow and immediate. The next 2 weeks represent a window in which existing pressures could resolve suddenly, rather than gradually. Markets rarely move when participants expect them to, but they often move. When positioning, liquidity, and psychology quietly align, the danger is not that silver moves higher. It is that it does so faster than most are prepared to manage. At the center of this dynamic is the relationship between silver and gold. Gold has already been signaling a shift in behavior, one driven less by conventional narratives and more by strategic intent. Silver, by contrast, has not yet fully reflected those signals. That imbalance is where risk concentrates. When adjustments finally occur, they tend to be abrupt. This documentary does not argue certainty. It examines structure, behavior, and risk under conditions where time compresses outcomes. Understanding what may be coming requires discarding comfortable expectations and examining how silver actually moves when its underlying drivers assert control. Silver has long been described as fast gold, a phrase that captures more than simple correlation. It reflects a structural reality about how silver responds once gold establishes direction. Gold tends to move first, absorbing strategic demand and institutional positioning in a relatively deep and liquid market. Silver, by comparison, operates in a far smaller arena. When gold's movement becomes persistent rather than speculative, silver does not follow calmly, it accelerates. This acceleration is not a matter of enthusiasm or narrative, it is mechanical. Silver's market size is limited relative to gold, which means that incremental shifts in demand exert disproportionate influence on price. When gold begins to trend in a clear direction, capital looking for leverage to that move often turns to silver. The result is not a smooth translation of gold's performance, but an exaggerated one. Small changes in gold can produce large reactions in silver. This is why silver's behavior often appears erratic to observers who expect symmetry between the two metals. Gold advances in measured steps, while silver surges, stalls, and then surges again. These violent movements are not signs of instability in the thesis, but symptoms of silver's structure, the same force that makes silver appealing. During strong metal cycles also makes it unforgiving when timing is misjudged. What distinguishes the current environment is that gold's movement is not being driven by short-term speculation. The underlying demand is steady, intentional, and largely indifferent to short-term price fluctuations that creates a persistent directional pull. Silver, as fast gold, does not respond immediately to that pull. It lags, compresses pressure, and then reacts suddenly once thresholds are crossed. Understanding this relationship is critical because it reframes volatility. Rapid silver moves are not anomalies that need explanations after the fact. They are the expected outcome when gold establishes itself as a leader and silver is forced to reprice into alignment. When that process begins, it tends to unfold quickly, leaving little time for adjustment. To understand why gold is leading this cycle, it is necessary to separate strategic demand from more familiar motivations. Gold is not being accumulated primarily as a hedge against consumer price inflation. Instead, it is being treated as a strategic asset, a form of insurance held by countries and large institutions operating in an environment where trust is deteriorating. This distinction matters because strategic demand behaves differently from speculative or cyclical demand. When gold is purchased as protection against instability, it is not intended to be traded frequently. It is accumulated deliberately and held with long-term intent. This type of buying is less sensitive to short-term price movements and more responsive to broader conditions of uncertainty, rising global tensions, fractured alliances, and increasing unpredictability in financial relationships all contribute to this behavior. Gold becomes a reserve of confidence when other forms of trust weaken. This strategic accumulation creates a steady baseline of demand. Unlike speculative flows, which can reverse quickly, strategic buying tends to persist. It does not require momentum to justify itself, nor does it exit simply because prices rise. As a result, gold's price action under these conditions becomes more stable and directional. It advances not because of excitement, but because supply is continuously absorbed. This dynamic explains why gold can climb without the typical signs of exuberance. There is no need for widespread public participation or dramatic headlines. The pressure is quieter but more durable. Gold's role shifts from being a reactive asset to a foundational one, reflecting precaution rather than optimism. This matters for silver because silver does not need its own independent catalyst when gold is being accumulated this way. Gold's strategic role changes the gravitational field of the metals market. Once gold establishes itself as a reserve asset under stress conditions, other metals tied to it are forced to adjust, even if their own narratives have not yet caught up. When gold is being accumulated for strategic reasons, its influence extends beyond its own market. Gold becomes the anchor, setting the direction and defining the environment in which other metals must operate. Silver, despite its distinct characteristics, remains tethered to this anchor. The relationship is not symmetrical, but it is decisive. Gold moves first, and silver is compelled to respond. The key is duration. A brief spike in gold would not carry the same weight. What matters is sustained movement driven by consistent buying. Over time, this creates pressure within silver's market structure. Silver can remain detached only temporarily. The longer gold holds its ground or advances, the more unstable silver's relative pricing becomes. This is where repricing risk emerges. Silver does not gradually recalibrate to gold's new level. Instead, the adjustment tends to occur in bursts. Once confidence builds that gold's move is not fleeting, the response in silver accelerates. The market shifts from hesitation to urgency, and prices move rapidly as participants attempt to realign. This dynamic explains why silver often appears dormant just before significant moves. The underlying driver is already active, but the reaction is delayed. When the response finally occurs, it can seem sudden and disproportionate. In reality, it is the release of accumulated pressure created by gold's sustained leadership. Silver's price behavior cannot be understood by looking at total supply alone. What matters is the portion of silver that is actually available for immediate trade, often referred to as the free float. This is the silver that can realistically respond to changes in demand without delay. The distinction is critical because much of the world's silver supply is not positioned to enter the market quickly, regardless of price. Silver exists in many forms that are effectively immobilized. It may be embedded in products, tied up in long-term holdings, or otherwise unavailable for rapid conversion into tradable form. When demand increases suddenly, the market does not have access to the full theoretical supply. It has access only to what is already refined, allocated, and ready for exchange. This constraint magnifies price sensitivity. Because of this structure, silver reacts not to how much exists, but to how much can move. When new buying pressure emerges, the free float absorbs it first. Once that portion begins to tighten, prices must adjust to ration access. The adjustment is often sharp, not because demand is extreme in absolute terms, but because the available supply is narrow. This is why silver is prone to abrupt price changes. Unlike assets with deep, flexible liquidity, silver's tradable inventory cannot expand instantly. Additional material takes time to be collected, processed, and prepared for market use. During that interval, price becomes the only balancing mechanism. Even modest increases in demand can therefore result in outsized moves. The effect is amplified during periods when attention shifts quickly. When silver moves from being ignored to being actively pursued, the transition happens faster than supply can respond. The free float tightens first, and the price reacts before the broader supply picture can adjust. This creates the kind of rapid escalation that defines silver's most memorable moves. The timing of silver's price movements is shaped by a lag that is often misunderstood. When demand rises, the market cannot immediately draw on all potential sources of supply. Silver that is not already in a tradable state must pass through a series of steps before it can affect pricing. Collection, refinement, and preparation introduce delays that cannot be shortened simply because prices are moving. During this lag, the market operates under constrained conditions. Buyers compete for what is already available, while additional supply remains out of reach. The result is a compressed period in which price must perform the entire balancing function. This is when moves become steep and difficult to manage. The market is not reacting to future supply. It is reacting to present scarcity within the free float. This delay explains why silver often appears calm until it is not. The buildup occurs quietly as demand increases without immediately visible effects. Once the available supply is sufficiently stressed, the adjustment happens rapidly. Price rises not in anticipation of future shortages, but in response to immediate limitations. Importantly, this process does not unfold smoothly. It is characterized by sudden shifts rather than gradual transitions. The market moves from equilibrium to imbalance quickly because the underlying constraint is temporal, not structural in the long term. Supply can respond eventually, but not within the window when demand first accelerates. Understanding this lag reframes expectations. Rapid price increases are not signs of disorder or irrationality. They are the natural outcome of a system in which responsiveness is delayed. In such an environment, timing becomes critical. The difference between early and late positioning can be measured in days rather than months. As prices approach major round numbers, market behavior changes in ways that have little to do with fundamentals and everything to do with perception. For silver, the $100 level represents such a threshold. It is not important because it alters supply or demand mechanics, but because it alters how the market interprets the asset. Numbers of this magnitude function as psychological cliffs rather than technical barriers. Below such levels, silver is often viewed as a niche market, followed closely only by specialists and committed participants. As price rises toward a figure like $100, that perception begins to shift. The asset becomes easier to frame, easier to discuss, and harder to ignore. Attention broadens not because the underlying story has changed, but because the price itself becomes the story. This change in attention can be destabilizing. Interest accelerates as observers who were previously disengaged begin to reassess. The move toward a psychological threshold compresses decision-making. Participants who delayed action are forced to confront the possibility of missing a larger move, while others begin to extrapolate momentum forward. The result is an increase in activity that feeds on itself. What makes this phase especially dangerous is that it often coincides with declining sensitivity to risk. As price rises quickly, caution tends to give way to confidence. The market narrative simplifies and nuance is lost. This is not because the thesis has improved, but because rising prices create their own validation. The significance of the $100 level lies in its ability to change behavior abruptly. Once such a figure is approached or breached, the market environment shifts. Participation expands, volatility increases, and discipline becomes harder to maintain. Whether the move continues or reverses, the transition itself marks a critical point where psychology, rather than structure, begins to dominate short-term outcomes. In an environment where silver is prone to rapid moves, observation becomes more important than prediction. The signals that matter are not dramatic headlines or isolated price spikes, but the quality of the market's behavior. One of the primary indicators to monitor is gold's continued role as a strategic asset, as long as gold maintains steady, intentional demand rather than erratic speculation. The underlying pressure on silver remains intact. Equally important is the nature of silver's momentum. Clean, directional movement carries a different implication than violent back-and-forth price action. Sustained advances suggest alignment between demand and market structure, while chaotic whipsaws indicate instability and internal conflict. The distinction matters because only the former tends to support follow-through. Physical conditions also provide insight. Tightness in available supply does not always announce itself clearly, but it often manifests through subtle constraints rather than overt shortages. When access becomes difficult without widespread acknowledgement, it signals that the free float is under stress. This type of tightening supports rapid price adjustments because it limits the market's ability to absorb new demand smoothly. At the same time, caution is required when sentiment begins to shift too far. As attention increases and narratives become uniformly optimistic, risk accumulates quietly. Euphoria does not emerge at the beginning of a move. It appears near the end, when prices have already traveled far enough to attract late participation. Recognizing this transition is essential to avoiding the most common mistake in fast-moving markets. These signals do not provide certainty. They offer context. Watching how gold behaves, how silver moves, and how physical conditions evolve allows participants to assess whether the market is strengthening or becoming unstable. The absence of fear does not imply safety, just as volatility does not imply danger. Interpretation, not reaction, is what separates awareness from exposure. Managing risk in a market like silver requires accepting conditions that are fundamentally uncomfortable. Volatility is not an anomaly here. It is the defining feature. The first principle is position sizing. Exposure must be calibrated so that sharp declines can be endured without forcing decisions at the worst possible moment. If a position cannot survive a significant drawdown, it is structurally flawed from the outset. Equally important is the acceptance that timing perfection is unrealistic. Selling near the top is exceptionally difficult, not because information is lacking, but because psychology becomes distorted as prices accelerate. Confidence tends to peak alongside price, and hesitation replaces discipline. A sound risk framework acknowledges this limitation and prioritizes survival over precision. Clarity of thesis is another essential component. Participation without a defined rationale leaves no basis for decision-making when conditions change. In a fast-moving market, uncertainty compounds quickly. Knowing what would invalidate the underlying view provides a reference point when emotions intensify. Without that anchor, every price fluctuation feels significant and overreaction becomes inevitable. Volatility also demands humility. Rapid gains can reverse just as quickly, and leverage amplifies both outcomes. Risk is not eliminated by conviction. It is managed through restraint, flexibility, and the willingness to remain exposed only to the extent that adverse moves can be absorbed. Ultimately, the objective of a risk framework is not to maximize returns, but to remain intact through instability. Silver's most dramatic phases reward those who can stay engaged without being forced out. This requires preparation not for what is expected, but for what is most difficult to endure when the market moves faster than comfort allows. Every rapid market move carries a final test, and it is rarely the move itself that causes the most damage. The greatest risk emerges when participation broadens and conviction becomes universal. This is the stage where late entrants arrive, not because conditions are favorable, but because price action has become impossible to ignore. In silver, this phase has historically marked the point where upside potential and downside risk converge. The warning is simple but difficult to follow. When enthusiasm replaces analysis, the market is no longer driven by structure or strategy. It is driven by reaction. Prices may continue higher for a time, but the character of the move changes. Volatility increases, reversals become sharper, and patience disappears. This is where most participants lose control of their process. The bullish case for silver is not unconditional. It depends on continued strength in gold and internal coherence within silver itself. If gold fails to maintain its strategic role, the foundation weakens. If silver begins to show signs of internal instability, the thesis loses integrity. These conditions do not guarantee immediate reversal, but they erode the justification for continued exposure. Late-stage markets are defined by contradiction. Confidence is high, yet risk is greatest. Clarity appears widespread, yet outcomes become more uncertain. Navigating this phase requires resisting the urge to extrapolate recent behavior indefinitely. No move remains fast forever. The purpose of this analysis is not to predict an exact outcome, but to highlight a narrowing window where decisions carry disproportionate consequences. Silver may continue to rise, or it may not. What is certain is that when speed and attention converge, mistakes become more costly. Recognizing that moment is the difference between participating in a move and becoming trapped by it.